So, welcome to another special episode from Weekend Investing. We do these special data backed episodes looking at past data and trying to draw insights from that data to help us in our future journeys. Today, we are going to talk about how small caps have been a hot subject and how we can uh, improve the returns, risk returns of a small cap investment by uh, doing some asset allocation. So as you can see in this chart, small caps have been on a tear, especially since COVID. And 5.5 times is what small cap index 100 small cap 100 index has risen since 2020. And Nifty, of course, in comparison is up only 217%. Now, the reason why most folks will not make money from small caps is because they will come in at the peaks and they will get out at the bottoms. So if we see the last 20 years journey, I mean, there have been several peaks like the 2008 peak here, 2011 peak here, maybe 2018 peak here, 2020 peak here, and there will come another peak whenever it will come. And most money will come in during this last phase and get out during these downward phase. And that's why, people will never make money on trying to time into the small cap space. So small caps, while they are extremely volatile and you can say that more difficult to time than even large caps, can give very fruitful returns if you stay invested in strategies which can sort of rotate out of losers. Uh, so if we were to somehow, create some asset allocation in our portfolios, so we can digest these falls. If we can sustain and digest these falls, our journey overall will become much, much more smoother. So let's look at addition of gold to small caps. It is a fantastic research done by my team, and we've added allocation of gold to small cap 100 index as an example. And this, of course, will uh, automatically also uh, apply towards any gold allocation which to any small cap small case if you already have. So the results is going to be even better because most small cases will beat the small cap 100 also index also. So the strategy that we are using here in this example is a monthly rebalance strategy. Um, and we will analyze the CAGR, the max drawdown, the volatility from market peaks and bottoms in this last 20 years. So in this last 20 years, we've had identified, let's say, 4 peaks, 7 peak, 10 peak, 2018 peak, and 2022 peak, and 4 bottoms. Uh, so let's start with December 2007 peak analysis from there. So what we're doing here is from that peak of 2007 December till today, if you were invested in 100 rupees invested in small cap 100 index, the other option is you invest 100% in gold, uh, or the third option is you invest 100% in 50% in small caps and 50% in gold. So these are the three variations that you will see. Orange line is 100% gold, blue line is 100% in the index, and the black line is 50-50 of small cap and gold. So what can we see here? If we invested in December 2007, gold has gone from 100 to 655. 100% small cap has gone from 100 to 334 only, despite this recent rally. But a 50-50 small cap and gold has reached 624. Amazing return versus 100% small caps. I mean, this is mind-boggling outcome that one would not have thought of. So if you had invested 50-50, would have done much better than investing only in direct small caps. In a tabular form, the same thing, 100% small cases, CAGR is only 7.4%, max drawdown was 75%, volatility of 30%, ROMAD ratio only 0.1. Whereas if you had 75% in small caps, 25% in gold, CAGR improved to 9.98, drawdown improved to minus 59, volatility reduced to 22.8, ROMAD ratio improved to 0.17. At 50-50, CAGR improved to 11.54, drawdown reduced to 39.6, volatility reduced to 16.5, ROMAD ratio of good 0.29%. Of course, at 25-75, CAGR improved further, max drawdown improved, and volatility also improved, raw material ratio also improved. And if you had only gold, you had 11.87 minus 25% drawdown, 16.8 volatility, and 0.47. So even at 50-50, you were able to reduce your max drawdown by a substantial amount, reduce volatility, improve raw material ratio, and improve CAGR. So from the peak of 2007, a distribution of 50-50 would have helped you a lot. October 2010 peak, here small cap gold 50-50 has done the best from 100 to 473. 100% small cap is at 435 and gold is at 357. So amazing return again. Again, you can see just by the chart, you can see the black line is very, very smooth versus the other two lines which are going up and down, and especially the blue line that will be having the most volatility. Again, you can see the 50-50 ratio has improved on the CAGR, 11.12 versus 11.81. Max drawdown has dropped dramatically from 60% to 20%. That is the power of a gold asset allocation. Volatility has reduced to 13.9 from 25.6, and ROMAD ratio has gone up to 1.57 versus 0.18. Uh, ROMAD ratio, if you don't know, is the returns to max drawdown ratio. So the higher that ratio is, the better it is in terms of volatility and overall risk returns. So again, a 50-50 ratio from October 2010 peak would have helped you. Now let's check the January 2018 peak. You remember small caps had crashed badly from January 2018. Here, the 100% gold has done the best. Actually, both are similar. 100% gold or 50-50 gold and small caps both have gone from 100 to 258. And the only 100% small caps have gone to 213. So again, in this period, also from this peak, CAGR has improved from 1186 to 15% for 50-50. Drawdown dramatically down from 60% to 20%. Volatility down. ROMAD ratio 0.72 versus 0.2. So again, the small cap and gold 50-50 has won beautifully. And if we see the January 2022 peak, and why we are considering peaks is because again, most people will come in near the peak. So even if you came in at these peaks along with asset allocation, you did really well. So January 2022 peak, here for the first time, small caps have done slightly better, 100% small caps, because we are currently running and we have not dropped at all. So 100 became 172. Small cap and gold is almost there, 168 from 100, and gold is at 158. If we see it from the tabulated point of view, CAGR is just a little bit lower, 20.83 versus 21.7. But max drawdown is dramatically lower, minus 11% versus 25% in this period. Volatility is at 10% versus 20.4, and ROMAD ratio is hugely up, 1.86 on this. So again, the small cap gold 50-50 ratio would have really helped you. If we tabulate all of this, you can see in all the 4 periods, you have an average of 13% CAGR returns if you had only small caps. You had an average of 14.8% returns if you had small caps and gold. And if you had only gold, you had 13.6%. So just sitting in small caps does not help. And of course, coming in at peaks and moving in out later would be a disaster totally. So this is from the market peaks, the worst case scenarios basically. Even in the worst case scenario of small cap investing, the asset allocation helps you tremendously. Now, if you look at the drawdowns, if you just had small caps, these were the drawdowns in the 4 periods. But with the asset allocation, these drawdowns were dramatically reduced. And if you take a look at volatility, the average volatility again was reduced from 25.9 to 13.9. So amazing reduction of volatility as well for the peak analysis. Now let's go to part B, where we will do a market bottoms analysis. We identified 4 bottoms: May 2004, March 2009, August 2013, and March 2020. And these are periods where rarely people will be able to get in, because this is a theoretical bottom fishing sort of point, and nobody can really catch the bottoms on a consistent basis. But nevertheless, for the period of study, we will assume that you can buy the bottoms, and let's see how the returns from the bottoms are. So May 2004 bottom, if you bought only small caps, you would have made 100 rupees would be to 2504 rupees in the last 20 years. Surprise, surprise, some small caps and gold would also have been very near that at 2378, and only gold, of course, was much lower at 1196. Again, the CAGR for only small caps in this 20-year period would have been 17.14%, but with a max drawdown of 75%. I mean, it's a gut churning drawdown. Very few can hold that. But with a 50-50 gold, the CAGR was only down by some basis points, 16.85, but max drawdown was down dramatically at minus 39.6%. And volatility reduced from 29.7 to 16.4, and ROMAD ratio improved to 0.43. Amazing outcome of small cap with gold. Now let's look at the next bottom, March 2009. If you were able to pick, you were sitting on small caps, pure small caps at 1339 from 100 rupees, done really well. In this period, small caps and gold did not do as much as the small caps only, did 959. So 100 to 959 is also not so bad in 15 years. And only gold, of course, was 447. If we tabulate this, then CAGR for 100% small caps was 18%, whereas for small caps and gold was 15.6. Drawdown dramatically improved again, minus 60% to minus 20%, volatility 27 to 15. ROMAD ratio improved from 0.3 to 0.7. So again, while the CAGR is lesser, the overall ROMAD ratio and your ability to sit through the drawdowns would be dramatically increased. The next bottom, August 2013, I'll quickly go through that. Again, small caps did well at 742, small caps and gold did 483 here. CAGR 19.8 on pure small caps, 15.24 on small caps and gold. Max drawdown again dramatically reduced, volatility reduced, ROMAD ratio is again, once again, a very good. COVID bottom, this would be the best for small caps, 100 to 539 for small caps, 325 on small caps and gold, and 181 on pure gold. 45% CAGR here if you did only small caps with a max drawdown of 25%. But if you did small caps and gold, you would be sitting at 30% CAGR and 11% only max drawdown. And ROMAD ratio going from 1.8 to 2.67. So while the CAGR is substantially up for small caps, we must remember that we are in the up cycle of the small cap uh, move, and we are measuring from the bottom. So when we see from bottom to bottom, that is the right measure, or when we see from top to top, that's the right measure. So from the peaks that we studied, and if we are near any peak or if we are on the way to a peak, that would be a better study. From a bottom to a peak probably is not the right study, but even then here the ROMAD ratio has come out to be very good. So versus the average 25% CAGR you would have got from the bottoms, using this strategy you would have got 19.4, which is not bad at all, uh, given the fact that your average max drawdown has also reduced dramatically versus the only small cap case, and your volatility is also dramatically reduced. So given the risk reward that you have, given the fact that whenever small caps will go into a downtrend, it will be very difficult to digest that fall. Small caps can fall 50, 60, 70, 80, 90%, as we have seen in the past. When small cap index itself falls 75%, you can imagine what can happen to some of the stocks. So this asset allocation really helps you stay put, and the strategy will help you to rotate into stocks with stronger momentum index, momentum ranking, and that is how you will be able to stay put in the strategy uh, and ride the small cap wave for a very long period without having to trying to time in and time out of small caps. And let me tell you, while it sounds very easy that we will get out when the market is going down and we'll get in when the market is going up, it rarely, I mean, I've seen maybe 10 to 20,000 client accounts in my lifetime, earlier as a broking company and now as into this research advisory. Very few people are there who can with discipline execute some proper strategy of their own, unless they are following a proper structure. Another thing that I can show you is the gold to small cap ratio. So this is gold divided by small caps, and it usually bottoms near zero point 0.3, 0.34 to zero point 0.4 as it has in the past. It also went much lower in 2008. Uh, so this is something where when small caps go up, this ratio goes down, and this ratio is now down. So it may be a good time where asset allocation to gold will really help your small cap investing. So if we just summarize, from peaks, gold has offered a terrific hedge to small caps in terms of bettering the CAGR, lowering the drawdown, lowering the volatility from any peak. So if we assume that 2024 is somewhere near some sort of peak, then gold allocation here will really help you very strongly. Uh, from bottoms, gold has performed 50 gold small cap 50/50 has performed well and has come close to small caps in terms of lower volatility and drawdowns, even though at slightly lower CAGR. So in both cases, the risk adjusted returns have been extremely good. This is a data point that you should absorb and try to inculcate in your investing. I think a lot of folks don't really measure their long-term performance and go from stock to stock or period to period performance. If you will sit back and see your last 5 years, last 10 years performance and calculate XIRR on that, you may realize that having asset allocation would really help you navigate the markets easily. You will have a more relaxed investing journey, and I can tell you that journey is very important. You may be wanting to get to that gold pot at the end of the rainbow, but that's never achievable. It's the journey that you must have, which is fruitful, which is enjoyable, and which is full of a sort of a fulfilling journey where you feel satisfied that yes, I've invested well, I've allocated well, and now whatever is happening is happening, and there's no sense of any panic or any distress or any sort of fear in your mind regarding this journey. So that's the sort of underlying theme, that if you do asset allocation, a lot of your fear should probably go away. So that's all for this episode. I hope you liked the content. My team has really worked hard on this research, and I would like you to at least subscribe to the channel if you like the content, and do share these videos with your friends and family. Who knows, somebody may get benefited out of this. Thank you. Bye bye.